Hello, fellow splitting geniuses. Welcome and thank you for tuning in to another episode of Splitting Smart. Split.fyi brings candid and informative discussions with professionals who can help support you through a divorce and your splitting journey. Our goal is to provide you with knowledge on various modalities of support that can help you to unhitch with fewer hitches, not further. After all, knowledge is the antidote to fear. Today's guest brings us a wealth of knowledge in the mortgage world and creative solutions to be able to keep the marital home when divorcing and dividing assets. I am Heather Steer, a divorcee, a CDFA, a divorce coach, and the co-founder of Split.fyi. Before we introduce our next guest, I wanted to let our guests tuning in know that if you have any questions, you can put them either in the Q&A or the chat box, and I'll be monitoring those throughout this episode. So I'll try to get them answered. We will have some time at the end as well. So fear not, we're here to give you as much information as possible. And without further ado, today's guest is Bridie Barringer. Bridie currently works at OneTrust Home Loans and has almost 10 years working in the mortgage industry with a particular passion for reverse mortgages and helping people creatively stay in their homes. Welcome, Bridie.
Thank you. Thanks for having me.
Oh, I'm so excited you're here. So I would love for you to tell people a little bit more about yourself and particularly like, how did you get into this, kind of niche specialty?
Well, interesting story. I got into reverse mortgages because my in-laws had a reverse mortgage, which I was one of the great populace that thinks that reverse mortgages are horrific. And I believed all the myths and stigmas behind them, but it did make sense for them. And so I did all my studying and went through all the process, asked all of the professionals I knew in the reverse mortgage world. And after going through everything, I thought, God, this is such a wonderful product. I really just kind of delved in it so much. We were able to get them we were able to sell their home that had a reverse mortgage, take those proceeds and then purchase another home as a reverse mortgage. And they are just on cloud nine. They just love it. And it's helped a lot of borrowers.
Okay, so there's so many things that you just said, because I was very much in your camp previously where I was like, oh, I don't like reverse mortgage was sort of like you're selling your home back to the bank. You're not owning it. It's kind of like the end of life. But you just said, one, they were able to sell their house when it was under a reverse mortgage and then use the reverse mortgage to buy another property. So let's do a little bit of that myth busting because, I am now a big believer in these and when the situation is appropriate, which we'll talk about, look at them and for my clients.
Yeah, so the number one myth is that the reverse mortgage, once you get into reverse mortgage, the bank now owns your home. So if something were to happen to you, if you and your spouse were to pass away, the kids don't have any rights to anything. It's basically a wash, right? That's how they make their money. Very furthest thing from the truth, right? They make their money by investing in your property, and it's a reverse mortgage in the sense that instead of paying down the mortgage, it grows incrementally based off the interest rate. So there's a slight increase in the reverse. You are not obligated to make any payments whatsoever. You can if you choose to do so. But over time, that loan will slowly grow higher. And so if you decide you do want to sell, you still have that equity has built between the time you start a reverse and the time you sell. Myth number two is the fact that you do have to live in your home. You do have to pay your taxes and insurance, but you can own other properties. So one thing that people think is that you have to do reverse mortgage if you can't pay your mortgage. You're strapped for money, you have no savings. Yes, that's true. It does help a lot of borrowers, a lot of the older borrowers that can't do a lot of things with maybe like Social Security incomes. They're strapped. But it's also another way to reinvest any equity in your home without losing your home and still living in your home, taking that equity and reinvesting somewhere else, which in most cases can give you a positive gain, can triple your return in investment somewhere else. So it's got a lot of options.
So if you're taking the money out, the bank is like, use it for whatever you want. So one strategy is to go put it into another property.
Mm-hmm.
Is that okay?
Yeah. So you can, let's say you have a mortgage of $2,000 a month, right? We're taking off the insurance and taxes because you still have to pay that. but let's your mortgage portion is $2,000 a month. You do a reverse mortgage. Not only are you removing that $2,000 a month obligation for your current property, but you are able to take whatever cash is available to you, or maybe just that payment in general. You can make the payment just fine. You just want to reinvest it into another property. You can take that payment and reinvest it into another property. When you go through that that purchase process with another property, you already have a reverse. You're clear. So they can use that income that you have stated for that $2,000 towards an investment. And now you can turn that investment property to what, 2 or 3 times, especially right now, it's a huge return.
Right. Oh, that's super, super interesting.
Yeah.
So what are some of the other myths with reverse mortgages?
Basically that, well, there's a lot of people that have different questions about it, but basically you're stuck in your home. You're not stuck in your home. You can leave at any time. You have to be there within so many months at a time. So you can have a second property. You can live somewhere else for a couple of months. You're also able to rent portions of your house out. So we have some borrowers who are older. They have a reverse mortgage, but now they rent a couple of units or rooms, or if they have like a separate property off. And so they can gain the extra income as well on the property.
Oh, that's fantastic.
Yeah.
Well, let's talk a little bit about there are some sort of statutory things with reverse mortgages, ages, and things like that. So let's walk a little bit through the traditional one and then talk about the, kind of some of the divorce.
Yeah, so there's two types of reverse mortgages. We have our HECM, which is the FHA insured. HECM stands for Home Equity Mortgage or Conversion Mortgage, excuse me. And then we have our proprietary. For those that are going through divorce, the proprietary is an option because it brings your age down to 55. Everyone's familiar with the 62 cutoff. 62 age is for HECMs only. I mean, you could be any age, obviously above 62 for the HECM option, but for the proprietary, you can go down to 55 years old, which is huge. The difference between the two, and I'll start with the proprietary first. The proprietary loans, you can borrow up to a higher amount. There's jumbo loans. So let's say your house is worth $2 million and you either don't have a mortgage or a very small mortgage. Your loan to value is based off of how much you owe and how much the house is worth. So the appraised value, and they extend their loan limits up to $4 million. So basically you're allowed to borrow more and allowed to extend more and have a larger reverse mortgage. With HECMs, which is the FHA insured one, two things. One is that their loan limit's capped at $978,000. However, in 2023, starting January 1st, they're going to raise that loan limit roughly $100,000. So it's going to be up to $1,082,000. So you've got some extra room there, but they're capped at that amount. When on the proprietary, you can go up to $4 million. The 52 and older, again, it's based off how much you have available to you, how much equity you have available to you. You can do a fixed rate option, which requires you to pull all that money available to you out right away. So let's say you have a home that's worth $2 million. Your loan is $200,000. Your current mortgage loan is $200,000. You would get a reverse mortgage for $200,000. And then let's say you have $200,000 available to you equity wise. They would require you to pull that all out at once on a fixed rate option. And then on adjustable, you have a line of credit. So there's different options there on the proprietary. I know it's confusing. There's a lot of sorry. I'm kind of trying to make it a little bit.
You're explaining it perfectly, but it is a little bit of a foreign language.
Yeah, and that's why it's good to call someone that knows this, because it really depends on the person and what you're trying to do, right? And it depends on the situation. How much money you have there, does it make sense for you? You don't want to just put you into any situation. And then that brings me over to the HECM, again, the Home Equity Conversion Mortgage, which is FHA insured. FHA insured means that you do have to pay a mortgage insurance on this loan. It's wrapped up into your loan. You're not coming in with any money or anything like that. It's based off the age of the borrower, It's also based off the interest rate and the appraised value. Same with the proprietary. But the thing about the HECM is that if something were to happen to you, two things: your loan is completely insured. So if we have any economic fall through, even if you're living in the home and now the house is underwater, you're not affected whatsoever. Secondly, if something were to happen to you, pass away, your heirs are not affected as well. And if it is underwater, they're not left with a bill, basically. But if it's not, and you do have equity in the home, two things will happen. The next of kin can purchase the home, whoever the heir is. Or secondly, if it is underwater, the borrower's next of heir could buy it up to 95% of the appraised value. So there's lots of options on the HECM version.
Oh, that's super interesting. And but the deal with that is there's a cap, an amount you can actually borrow out of it. It's a fixed rate.
You can do both the fixed and adjustable on that one.
Oh,
but
you can
yes,
do both.
There's a cap, and then you do have to pay mortgage insurance. You're basically paying an insurance policy so that anything happens, it gets covered via FHA.
Got it. Okay.
Yeah.
It's sort of like our original PMI if you didn't have 20% down.
Yes. So exactly. That's perfect. Some people don't know that, but that's exactly it.
Okay.
But a nice little caveat for the HECM, which is great for divorcees, is if you are going through divorce and you do want to stay in the property, the HECM will allow you to withdraw 100% of the funds available to you if it's under court order or divorce decree. So
Okay.
basically, you're not limited and you're able to pull all the funds out 100%.
And then people out there, make sure that you put it in your marital settlement agreement, because
It's a court order, they have to follow it. Yeah.
Yes, I do see people not properly document. So that's when it's really important to bring in the mortgage specialist so that you make sure that the language is going to pass underwriting for what you're trying to do. Just pro tip out there for everyone. Okay, so
it's hard to explain all the different layers to these two programs, because there's, like I said, there's so much to it. There's so much benefit, and it's not necessarily for the person who needs it. It's financially, it's those people that need it to kind of rearrange their assets, or maybe they don't want to liquidate all their stocks. Right now is not a good time to do that, right? But the equity, you got the equity there. You're not losing the house. You don't have to sell it and repurchase at a high market. You're still in your home. All of that's beneficial to you. So there's just so many little niches to what you can do. It's huge. It gives you a lot of benefit.
That makes me think about another myth buster on reverse mortgages, that you can, well, correct me if I'm wrong, refinance back out of a reverse mortgage into a traditional quote unquote mortgage as well, right? So people think they're locked in.
Correct, you are. But there is a requirement, not back and forth. So if you were to do let's say you were to do a cash out refinance. So I'm going to do both ways. If you were to start with a traditional loan, which is, your conventional VA, all that good stuff. And you were to do a refinance where you pulled any money out. And let's say 6 months later, you thought, I should probably do a reverse mortgage. You are required to wait a year before you can refinance into a reverse mortgage from a traditional mortgage, if you were to pull anything greater than $500 out of a cash out, right? Even if you get money back. Okay.
So cash out, if you did a cash out refi, you're going to need to wait 1 year in order to then do a reverse mortgage.
Correct. To close a reverse mortgage.
Okay. But if you're in a reverse mortgage, you can go back to a traditional.
You can't go back to a traditional. Yes. There are some small stipulations on that, but it's really just based on each person. But no, it's completely allowed. There's no time frame whatsoever between the other way around.
Okay, because I found, I'm thinking of one client in particular where she was able to do that and then go back out into the workforce, rebuild, her ability to earn in her income, and then she got, refinanced back out, and then you get, she got to a more traditional product.
Yeah. That is a huge benefit. I like that.
Yeah, it bought her some time. So that was a great option for her. Okay, so what else for the divorcing? So did we cover the age?
We did cover the age 62 and greater for the HECM option, but for the proprietary, it's 55 and older. The proprietary is the one that has a higher lending limit amount of the $4 million,
Right.
which could be beneficial depending on the area, right? Depends on the home values in different areas. But let's say the divorcee is, or let's say they're going through divorce and they don't have enough equity in there to do this split. It doesn't really make sense for everybody, right? Ultimately, they're going to be required, either one or the other spouse is requiring the sale of this property. Well, it doesn't mean that you're limited options. So your next option actually could be a reverse mortgage as well. They do HECM for purchases, which is what I did for my in-laws. Huge, right? Let's say during the sale of the property, or, simply maybe it's just too big of a house. If you're by yourself and you don't need this huge house, you've got tons of equity, you can take that equity and purchase something that fits your needs and what you'd like to do long term. So just for reference, let's say your equity is 800,000, or let's make it $1 million to make it easy for everybody to calculate everything. Your spouse takes 500,000, you keep 500,000. You can purchase a home or a condo, a townhome, you name it, up to the best calculation is roughly half of what your money is. So let's say you have for 500,000, you can use all of that to purchase a home worth $1 million. You could take part of that, put it in your pocket and keep it for savings, and then now purchase something a little bit less. Basically, you're just putting roughly half down.
Okay. So as long as it's 50% down.
Yeah, that's a good calculation to follow.
And you can do a reverse mortgage, and then therefore you're in the property, but you aren't paying the mortgage balance. You're doing your property taxes and insurance.
That's it. Yeah.
And that's under a proprietary.
That's actually your HECM option.
That is a HECM option. Okay.
That's the FHA one. Yeah. So, but people don't have savings, and that's their only savings is the equity. So they've got a couple $100,000 in their savings account, and they're sitting pretty. Maybe they didn't work before. Maybe they're going to divorce and now they're the spouse that stayed at home and they're kind of limited. I'm sure there's a lot of things that you could help them out with on that one, but they're not feeling so strapped, and now they can get something that they want that makes sense for them and kind of tailors to their needs.
Yeah, 100%. It's the downsizing around divorce. That's a very cool solution for people who do need to move out of the marital home, and then, particularly in our market where it's so hard to get into houses. I'm finding that across the country when I talk to my professional market world there, everyone is struggling with that. So that's really fantastic.
It could be new. It can even be new construction. There's a lot to it, right? One thing that I've been working really hard on is educating the real estate agents about this too, because it's not very often, it's not all the time, but I think we're going into a market which will allow a huge amount of this because their purchasing power is a little bit greater with less money, and they don't have to pay this large mortgage payment with these high interest rates, right? They're kind of essentially put themselves in a nice, safe situation. So I think the more people understand. Go ahead.
I think, education is just so huge, and trying to get people to understand these options. What is the typical kind of interest rate difference between the kind of the HECM versus a traditional loan? I know it changes, but it's very.
I'm sorry, repeat that question again.
What is the interest rate difference in the
versus traditional and a reverse mortgage? Well, that's a great question. It's always changing. We are affected by that change in the rate as well. Ironically, they're kind of at par right now. They're kind of on the same level, just because we're dealing with the higher interest rates today. Generally, and they go down too, but the interest rates go down. generally speaking, when you're getting into reverse mortgage, your interest rate is really not that much of a concern, for two reasons. One being is that you've kind of already reconciled that this is where you're going to be, and that you're building the next chapter in your life. You spend the first 30, 40 years paying for this mortgage, building this equity, right? And you're worried about the interest rate. You don't want to spend too much money. Totally get it. But then the second chapter of your life is is not working, enjoying that retirement, having more money in your pocket to pay for any luxury, travel, medical. Maybe you don't have money set aside should something happen to you later on in the future, and now you can pay for those medical in-home care or outpatient kind of care. So you're planning for the next half. The interest rate's not outrageous or anything like that. Like I said, they're very much on par with what's going on the traditional side, but it's less of a focus than it would be on a traditional side, because you're not really worried about the next few years. You're just enjoying that you don't have to leave. You're not forced to move out of the house. If something were to happen on a traditional side and the economic stance were to get worse, you're worried about making that mortgage payment. You're worried about foreclosing. You're worried about your house going away. You don't have that worry on the reverse side ever. Doesn't matter what the situation, you're never going to have to worry about it. So it's just a different way of looking at it.
No, that's a great answer on that. Thank you. Okay, what else do we need to cover in this? Because this has been, already I have so many notes written down.
Well, I think really, so I work a lot with financial advisors. So I would assume that your clients and people that are getting divorced, are going to come into a certain amount of wealth that they either are going to be taking away from a marriage, a property, maybe 401ks, any kind of structures that way, maybe some insurance policies, however they structure it. I do deal with a lot of financial advisors that are able to the best, I should say, people who are helping people structure their next moments in life is a better way to put it. Utilizing the reverse mortgage because it puts that safety back into the clients. They don't have to worry about the long-term planning or the strapping of having to just remove all the retirements, liquidate all their retirements for the process of this divorce. Kind of takes that stress away and puts them in a nice, comfortable situation.
Yeah, no, I think it really makes a difference for those clients that are heading into that retirement, or they were the non-wage earning spouse or whatever, to provide security. And unfortunately in divorce, 1 + 1 doesn't equal 2. So it's, even though there's 100% of the assets, it's just a little bit less, whether it's because you're paying them out to professional fees or whatever it is. You don't end up as whole as you were.
Well, like you said in the beginning, right? Knowledge is power. And the more you know about a situation and you know how it's going to benefit you and you know the structure of it, like someone in your position that's able to help them kind of guide them through all that stuff, it's so huge because now they've got that confidence. Even going through a divorce, not having that confidence and knowledge, someone can kind of easily poke you or step around you or push you into a situation you don't really want to be in because you don't know it completely. Yeah. So once you understand it completely, you can't get pushed around because you have the confidence that that's not correct. I know how this works. I know what I need to do to get things, to line up for myself or whoever that person is.
Yeah. And it's one more point of flexibility when you're looking at, how you're going to strategically split assets to try to make people come out, collectively as financially whole as possible.
Yeah.
So this is, I think a great tool to look at that. And, whether it's you need more runway because you're going back into the workforce, or there just aren't the assets to pull out from other places due to equalization and one party wants to stay in the house. There's so many good reasons to look at this as an option. So I think it's a fantastic resource in the right circumstances.
Yeah, I do too. Sometimes I think I'm like, oh, I can't wait to get there. So I'm going to have all my stuff planned out. I'm going to, just like later on, use my equity and leverage it. It's just, I see that relief on my clients when they close, they have the money, and like I said, it's for everybody. There's different situations. It's those who need it really badly and those who don't necessarily need it, but they're just making it work for them. So it's huge.
Yeah, to actually build, further investments and stuff. I thought that was such a great idea.
Mhm.
I
Especially
totally,
now. That's a good time now to do that too.
no, you're absolutely right. So, well, okay, I'm going to put in the chat how we can reach Bridie. If you have questions, you want to look at this for as a solution for you. I have to multitask. Let's see, here is her email and then her website as well. I can't copy and paste right now, so and there's her website, and I'll read it out loud. It's onetrusthomeloans.com/LO/B Barringer, BARRINGER, and B Barringer at onetrusthomeloans.com is her email as well, but you can pull that out of the chat. I don't see any questions. So I think we are going to wrap up, and I really appreciate your time and for everyone who joined us in their journey to become a splitting genius. Bridie, I think you added a lot of value, and I look forward to talking to you again soon.
Thank you. I appreciate that.